flying in that both are continually changing environments and you cannot predict what's going to happen next. So just as pilots have checklists that they follow in case of an emergency, I've learned over the years that investors really need to think about, gee, what will I do if? But
we're going to do a go around. We're going to, check the plane first. Isn't that it?
Yep, a pre-flight inspection, yes.
Pre-flight inspection. Now, any stocks that we end up screening for, or any inputs that we actually put into stock screener, this is just being shown for demonstration purposes only. This is not intended to portray any type of recommendation to buy or sell any particular security or to put on any strategy. It's just so that you get more comfortable with how you can use these different tools that are available to Schwab customers for free. Now, if we do talk about technical analysis, I would like to stress that Schwab does not recommend the use of technical analysis as a sole method of investment research. And I think, Mark, you have an additional disclosure as well.
As a chartered financial analyst, which is the certification in fundamental analysis, I'll add a personal disclaimer, and Mark EIDEM does not recommend the use of fundamental analysis as a sole method of investment research. The reason we really recommend blending both disciplines, we'll actually talk more about this as we get into screening today, is that fundamental analysis, how the company is doing as a business, to me, that's what to buy, or more importantly, what to avoid. We'll probably run into a couple of examples of that today. Technical analysis helps with when to buy, and it's, to me, the first step in when to sell. Again, more on that later. So let's drive on, Lena.
And now for our cross-check here, as a pilot, I think, would say, we're going to talk about stock screening tools, but we're going to switch it up. We're not going to be using Street Smart Edge today. Many of our sessions, we do utilize that particular platform. So you could check out Trader Talk, Charting the Markets, or many of our options-related sessions where we use Street Smart Edge and the stock screening tools that are available there. But today we're going to mix it up a bit. We're going to go to schwab.com because Mark wanted to, screen for some stocks that might be of interest to those dividend-oriented investors. So let's take a look at schwab.com. And Mark, can you help us navigate, where's the best place to actually immediately get these screeners?
Sure. Before we talk about the techniques of screening, let's talk about the importance of having a plan. And first of all, a personal financial plan that clarifies the goals you're pursuing, how much you want to save, when you want to have that, and so on. And perhaps even go beyond that. And one of the things I like to talk about from a retirement planning perspective is, not just, hey, I want to retire at age 65 on $100,000 a year. Okay, great. That's a goal. And if you've ever heard the acronym SMART goals, it is specific, it is measurable, it is probably achievable, it is hopefully realistic, and it's time bound. But it, to me, doesn't really inspire much in terms of proactive action. It's, if anything, you talk about the carrot and the stick. Gee, I want to retire at age 65 on $100,000 a year. I need to save more and spend less. That's the proverbial stick. But if you were to really go in a little bit more detail, gee, where do I want to live? Do I want to have a snowbird hideaway somewhere? I grew up in Alaska, and Nina, I know you live in Chicago, and actually Chicago winters are worse than Anchorage. Do you want to have a snowbird hideaway somewhere? If so, where? What's that look like? What activities do you want to pursue? Do you want to play golf or tennis 3 days a week? Fishing, hiking? Any special purchases you want to make, like a boat or a motorhome? And literally almost to create a vision board, for lack of a better term, of what you want to do. And that then becomes the carrot that drags you forward to take compelling action. Same thing with education, same thing with estate planning, and so on. So that's an overall financial plan, but as we approach our investing plan, and dividend investing can be one aspect of your overall investment plan, but let's talk about, and we're going to put 4 steps in this process: screening, which we'll focus on today, a little bit of research, which we'll get into perhaps, execution. This is, position sizing. How much will I buy? How will I buy it? What's my sell discipline? And then monitoring. How often will I review my portfolio? So that's a specific investment plan for a dividend-oriented stock. So Nina, you're already set up. You've hovered your mouse over the word research. You've gone to stocks, and just move your mouse around the screener so people can see that. And then click on screeners. So now we're actually going to talk about some things, um, is some key things you might want to consider in screening for dividends. So there are some, you have the ability to save screens, and Nina and I were joking before, asked, gee, what's that Super Tuesday screen? And it's something that, well, Nina, I'll let you tell that story.
Right. So I did that session with Robert Kamek, and it actually was on the morning of the Super Tuesday election. So we decided to call it that. So yeah, you could save your screens, but the thing is, times change too. So maybe the screen that you did a year ago isn't as relevant, as it is right now, because interest rates change. The 10-year, for instance, Treasury, the yields are different than where they were just at the beginning of the year. So that means that you might need to adjust your criteria as time moves on.
Mm-hmm. And by saving a screen, you don't have to rebuild it from scratch. If you decide you want to change some of the criteria, you can just pull up that save screen and modify the criteria you want to change. So as we start to build a screen, you'll see there are some predefined screeners down below, but we're going to build our own from scratch. So we want to think about, well, gee, what are the criteria I'm looking for? And obviously we're going to talk about dividends. In fact, that's where we're going to start, because I want to have the criteria that I would like to use as my primary sorting criteria. I want to have those first. So there are several different things on that screen. Nina, if you would check on the box increasing or decreasing dividends year over year. YOY means year over year. And that pops up. You see it up there. Click on increasing. So we have 2 choices there. We want to avoid those companies that have reduced or cut their dividends.
And at the beginning of May, companies were suspending their dividends at the fastest pace in years. There was an article in the Wall Street Journal that as of early May, over 80 U.S. companies have suspended or canceled their dividends, which is the highest number since 2001.
I think that just might include companies within, the large cap indexes like the Russell 1000 or maybe even the S&P 500. I've tracked another source, and this is actually a week and a half old, but there were 268 companies in the U.S. market that had reduced or eliminated their dividends, and that truly is unprecedented. I've been in the industry for 35 years. I haven't seen anything like that. So we want to focus on those companies that increasing their dividends. And we'll actually be able to sort on that first. Okay, so the next thing we want to be able to focus on is the annual dividend yield. So that gives us the annual dividend yield. It's the dividend paid in dollars divided by the share price. So this is where we have to get a little bit creative, for lack of a better word. A good benchmark in normal times, and certainly this is anything but normal times, Nina, a good benchmark in normal times is to take the yield on the 10-year Treasury bond, which is to the bond market what the Dow Industrials are to the stock market, kind of your benchmark index, and then no more than 2, maybe 2.5 times that. But with the 10-year Treasury well below 1%, but yet because of the drop in stock prices, the numerator there, sorry, denominator, um, dividend yields have actually risen and the interest rates on treasuries have fallen. So we're going to go to our annual dividend yield and we're going to look for companies, if you'll move over to the right for just a little bit, where rather than use the buttons there, the so-called radio buttons, there's a blue link, enter specific values. If you click on that, we're going to use between, but just to show people, drop down that menu. Got several choices there. So we're going to use between, let's say 4 and 7%. Now in normal times, that would be high to crazy high, but today it may be somewhat reasonable just because of the unique times we're in. Now, you notice there were 1,407 companies that had increased their dividends, and there are now 284 companies that have increased their dividend and have a yield between 4 and 8%. Nina, could you get rid of that pop-up thing that popped up there? That's one of the internal messaging systems that we
I
have at
don't see
Schwab.
it. There's a
Oh,
pop-up.
oh, never mind. It's on my screen.
Now, the current S&P 500 dividend yield, I believe, is about 1.87%.
Mm-hmm.
That's what it is right now. And then you were talking about the 10-year. At the beginning of the year, when we had, the lowest unemployment in years, but at the beginning of the year, the 10-year Treasury yield was 1.8%. And right now, the 10-year is around it's a lot of these Treasury yields have been climbing today, but it's at about 94 basis points. So not quite 1%, but it's over the past couple of weeks, it's increased quite a bit.
No, it's the 10-year Treasury yield has actually, I think, been more volatile than stocks. We went from 1.8 to 0.4. In 7 days, we were back at 1.3. 3 days later, we're at 0.6. It's just been, that's why I wouldn't use that right now. It's just been so wild. So the next thing we want to put in there is 3-year dividend growth rate. We've seen increasing dividends year over year, but we want to see how much does that dividend grow per year. And again, we want to use enter a specific value for that.
All right. Let's add that.
Enter
You want a specific value. We'll click on that link.
And this time we want greater than or equal to 7%. Now, I really want to clarify something here. That's the dividend growing at 7% per year. In other words, if a company pays $1 a share today, a year from now, that should be $1.07, and then $1.14, and so on. That's not necessarily the dividend yield. That's how fast it grows. Why 7%? Many of you may have heard of something called the Rule of 72. If you haven't, do a Google search. The Rule of 72 has its own Wikipedia page. But it is a mathematical formula that you take a given growth rate, divide it into the number 72, and that gives you the approximate years it will take something to double. So if a dividend grows at 7% per year, and it's $1 a share today, in roughly 7 years, 10 years, 7 into 72, that dividend should be around $2 a share. And not only is that a nice theory, empirically it seems to work out over time as well. So now we have 152 companies that have increased their dividend. It's between 4 and 7, and the dividend growth rate has been greater than 7% for the last few years. One more criteria, if you check on payout ratio TTM, and TTM means trailing 12 months, ladies and gentlemen. So that the dividend payout ratio is what percentage of a company's earnings are they actually paying out as a dividend. So again, we're going to use specific values. And in this case, I want, click that blue link, enter specific values. And I want less than, so click less than or equal to 50%. Normally, you might be able to go up as high as 60, but because of the pressure on revenue growth and sales growth, we want to be extra cautious. So we started with over 1,400 companies. We're now down to 64. So now those are the 4 criteria from a dividend perspective that we want to look at. Again, this is not the cat's meow. This is not necessarily the be all end all. It's a method. But now if you would click on the basic criteria up above, and we'll add a couple of things in here. So in the basic criteria, one of the first things we want to check on is, let's see, sectors and industries. Now, the only reason for putting this criteria in is that we want to be able to sort on that. So we want to go down and select all. So that'll put a check mark by all of those.
There we go.
Okay. Now that doesn't change our count at all, but it will enable us to sort. And over time, you'll see that the industries that have dividends that meet these criteria will change. Right now, it's very heavily skewed towards financial-based companies. So, and again, that changes over time. So scroll back up to the top, and we want to take a look at our universe. So here, the universe, you'll have to now scroll up and down every time we do this because we're far enough down the screen. We want to select domestic stocks. Now, there's nothing wrong with international companies, but I would point out that once you get beyond the developed countries of the world, we have no idea what the accounting standards might be. And if you follow the saga of Luckin Coffee, a Chinese company that and one of many, unfortunately, not just Chinese, but many emerging markets just don't have the solid accounting standards. And Luckin Coffee took a big plunge when it was discovered they've done some fraudulent accounting. So that's something we want to be aware of. All right, back to the top again, and there's one more criteria, and then we'll go to screening. And that is, if you don't click on it, but you notice our average volume over 10 days, you can point towards that. To me, that's not long enough. Don't click that one, but we want to click optionable stocks.
I like that.
And we don't care if we want to trade options. I would use this just as a proxy for average daily volume over a longer period of time. Because, well, Nina, you spent 7 years on the floor of the SIBO. What's the lower end of the average volume an optionable stock would have?
Well, you know what? I was on the stock selection committee, and originally we wouldn't, but things have changed, but we wouldn't consider listing a stock. Now, this is way back when, okay? This is like almost 20 years ago. But the stock needed to have, over those past 2 years, over 200,000 shares a day to be newly listed. But then once you listed them, many times the market makers in the pit, they didn't like trading these stocks until it had more volume, just a lot more volume, let's say 750,000 shares a day or 1 million or more a day. I traded everything that came into the pit because I was new, and that's what you got to do. And old timers could pick and choose, and they were very successful, and they had and so they like to trade the more actively traded stocks.
Okay. See, I've always heard the number roughly 500,000 on average, and of course your mileage may vary, but these are some things to consider. Again, this is not the approved solution. This is a methodology. All right, so now we want to save this screen.
All right, we're going to have to name this. We're going to have to name.
Nope, you got to go down to the bottom.
Yeah. Wait a minute. Yeah.
All the way down to the bottom. I've got a good name for this one. Yep.
What do you want?
Happy Friday dividends.
All right, all right, is it?
You have to scroll down a little bit.
Oh, there we go.
There,
there we go. It's at the top. It's trying to tease me. Happy Friday
dividends.
Dividends.
Okay. There we go. So now that we've saved this, we can come back and modify these criteria probably, as we get back to a normal kind of an environment, maybe you'll want to reduce the dividend yield. But for now, let's go with what we've got.
Now,
And
we
really,
didn't include any analyst ratings, and we do have a question from Tom in New York,
yep,
and he's wondering, do you like to incorporate different ratings, let's say from Ned Davis, Argus, Morningstar, or let's say the Schwab equity ratings, SER?
yeah. And Tom, you're probably correct in that the Schwab equity ratings tend to have a bit more of a value-oriented slant. Um, but totally personal opinion, I generally don't include any analyst ratings. And the reason for that is years ago, I wrote an article for Schwab. It's since fallen off the system, but look beyond the rating, read the commentary. And really, the ultimate drift of that article is exactly what you just pointed out. Every analyst, every analytical method is going to have an inherent bias based on who wrote it towards either value investing or growth investing. And Nina, these folks don't wear jerseys like the Seahawks and the Bears, so you can't tell which team they play for. And that's where each individual investor, you might have a more of a value or more of a growth bias, but without reading the commentary, you don't know what the analyst's bias is. So totally personal opinion, I tend to not put any analyst ratings in there, not because they're not valid. It's just they're an opinion, a considered professional opinion, but they may not match my worldview, or they may not match your worldview. Yeah, and along those lines, there's a question from Tech in Washington. Hi, Tech, welcome back. What do you look for in screening stocks that you want to own? Is it low volatility, value, total assets, past performance, et cetera, et cetera? And this really gets back to the importance of defining your personal financial plan. What are your particular goals and objectives? And again, you might have multiple goals. You might have retirement goals in 15 years. You might have college you need to fund in 3 to 5. You're going to have different goals for those different pools of capital. So with that, let's, by the way, please keep those questions coming. We do the best job for you when you keep asking questions. So keep them coming. And now let's go to, from screening, we're now going to switch to the research phase of our process. View 36 matches.
All right, Roger. I'll click on it. There we go.
Okay. So now these are the companies we found, and you can hide the screening criteria.
See that? You just click on this hide to move it over, move on over.
Yeah.
There we go.
And you can do the same thing with screener criteria up at the top. Go all the way up to the top for a moment.
Hold on a second.
Yep.
Oh, no, show, wait a minute, where is that?
No,
I can hide
just
this
to the
stuff?
left of increasing or decreasing dividends, black screener criteria. There you go. Click that, and that hides that. Again, giving you more room on there. Okay. One other thing while you're up at the top. One other thing you can do while you're up at the top, you notice you can get this in a pop-up, or you can export to an Excel spreadsheet. Don't do that right now. Well, click cancel.
You can click on it.
Right
yeah.
So now we have a listing of companies, and you see there's a little triangle by the word symbol up at the top. Now that tells you which criteria you're sorted upon, and when you click that, of course, it changes. The pointy end of the triangle is A, or the lowest. The wide end of the triangle is Z, or biggest. Okay. So let's click on increasing dividends year over year. We click on that once, that'll show us the lowest dividend growth, and then click on that again, and that will show us the highest. And sure enough, the 3 companies at the top of the group, 4 out of the first 5 are all regional banks. You see over in the sector, financial, technology, financial, energy. Gee, how did an energy stock get in there? But you can sort these. It doesn't change the members in the list, but it changes the way in which they're displayed. So hover your mouse over NTAP, NetApp, we'll go with the technology company. And you can see there's up to a 3-year chart. And if you scroll down a bit more, if you've never heard of NetApp or Network Appliance, you can actually get a short business description of who they are and what they do without ever even clicking. We haven't done anything. So now let's click on Network Appliance, and we'll
All
actually
right.
go over and look at some both fundamental and technical research. Now I'm going to do something that may sound a little outrageous here, but I'm going to make a statement. I think we can look at this and research this company within 5 minutes. And the reason is, and I bet there's more than a few eyebrows that just went up around the country. How can you research a company in 5 minutes? The answer is we're going to be very selective. Nina, I don't know if you ever played baseball growing up, but how many strikes do you get in baseball?
Well, we played softball here. I'm a,
Okay.
Chicago South Sider, and
Mhm.
3 strikes and you are out.
That's correct. Well, this ain't baseball. So we're going to take an even more restrictive approach. And if we see one thing we don't like, 1 strike and you're out. That's how we can research a company in 5 minutes. Okay, so click on we're in the summary tab. You can see we're looking at a year-to-date chart, but let's look at a bigger picture event. Click on 5 years, and we want to get rid of those show events.
All
Those are
right.
the
Yep.
earnings and dividends. So uncheck show
Mm-hmm.
events. Now, you don't have to be a card-carrying chartered market technician to figure out, gee, which way is that trend going? Down.
Yeah, it's been down.
Yeah, downtrend is a series of lower and lower highs. And over the last 5 years, it's barely above where it started 5 years ago. So from a technical perspective, no matter how good the fundamentals be, this may not be something we want to add right now. However, in the interest of time for our program, we're going to keep going. I would contend if you're looking at this particular company from a technical perspective, not, there's your 1 strike right there. But let's now go, and if you would, up on the top tabs, let's look at earnings. So
There
click
we
on the
go.
word earnings. Now we've moved from the realm of technical analysis, what is the trend in the price of the stock, to now we want to look at fundamental analysis or earnings. And if you would, Nina, please click on quarterly right below the word growth. And this will give us up to 3 years worth of quarterly earnings. Now, below that, you see there are 2 choices, GAAP and non-GAAP. GAAP stands for Generally Accepted Accounting Principles. I think, okay.
It should be
So,
okay.
all right. So you always want to come back and look at Generally Accepted Accounting Principles because it's a consistent set of rules across all industries, across all companies. And if you go over to the right-hand side, you'll see there's annualized growth rates. So this is a great example of where a company met our screening criteria, or, and yet from a research perspective, not so much. 5-year earnings growth 15, 3-year growth 27, 1-year growth negative 22%. And if you look at each one of those earnings, Q4 versus Q4 a year ago, that looks like just over half of what it was.
Mm-hmm.
Q3 versus Q3 a year ago, that's actually slightly better.
That one was
Q2
better.
versus Q2, basically
A
flat.
little better. Mm-hmm.
Q1 versus Q1, way
It was
down.
bad. Right.
Okay. Scroll down a little bit because we also want to look at sales.
Oops,
And
my computer accidentally increased the viewing size there. All right, and you
there
wanted me
may
to
be
scroll
human
down? Yeah, there we
really
go.
mess things up. You need a computer. So
There's
now we're
revenue.
looking at revenues. Now, it's important, I would contend, to look at revenues as well, because many companies will try and increase their earnings by cutting costs or buying back shares. And okay, those things will work, but only for a period of time. If you really want to grow the business, ultimately, you've got to sell more widgets. You've got to add money to the top line sales. And if we weren't out of this one before, this is a deal breaker. Negative 5-year sales, negative 3-year sales, negative 1-year sales, you're out of there. But again, in the interest of time, we want to keep going. So scroll back up to the top, and now we want to look at one more area, and that is the dividends tab. Now, Schwab has really enhanced this dividend tab in the last year, year and a half, and this will show me up to 8 years worth of dividends. And now we can see what's actually rather attractive about this company, a very rapid dividend growth rate in the last 2 or 3 years. And you might be scratching your head and going, how'd they do that? Remember, their earnings were still growing. Now, if you click on, you see the calendar year dividend history by X date down below that. Nope, not there, down below the blue bars.
Here. Oh.
Click on Open All.
Okay.
What this will show us is how long and how much have they raised their dividend. So here actually is another troubling piece of information for me. It's now 5 quarters since they raised their dividend. And ideally, you want to see a company that raises their dividend every single every single fiscal year. So if you look there, February 13th, 2019, the dividend was 40 cents a share, and the next quarter, it was 48 cents. So the May quarter was when they raised their dividend. Now you look at, they just announced their May dividend, and they didn't raise it. They've kept their dividend the same for 5 quarters. You're no longer a dividend growth stock. Now, when you go down to the dividend payout ratio in the statistics block, on the right-hand side, if you go down upcoming dividend rate statistics.
Okay. This section here.
Yeah, point to the dividend payout ratio, and that's, whoops, close that. That's only 41%. That's okay, but management has decided not to raise the dividends. Again, strike in my book. Remember, it's totally personal opinion, but if you haven't raised your dividend in 5 quarters, management is basically saying, that dividend we paid you last year, well, we normally increase it, but right now we're going to hold it where it is. We're doing okay, but we're not doing okay enough to raise the dividend. Now, you'll never see that in the press release, Nina, but that's exactly kind of what they're saying.
They want to hold on to their cash. Now, the thing is, though, we selected in the screener a dividend payout. I believe it was 50% or less.
Or lower.
Right. And so if a company, if we did have a higher screen, let's say we had 70%, what is the risk if it is above 50% that they'll cut the dividend?
Yeah, ideally we want to see the dividend payout ratio 50% or lower. But as Mick Jagger once observed, the Rolling Stones, you can't always get what you want. It's really not a problem until a company starts paying out more than they earn.
So it's over 100.
Over 100%. What you want to be careful of is as you're researching a company and as you're monitoring companies over time, which is in essence researching a company. If you see that dividend payout ratio start to creep up from 40 to 60 to 80, that should raise an eyebrow or two. But once it gets above 100, and companies can pay out more than they earn for a few quarters, but there are only 3 ways they can do it, and all 3 are bad for long-term business. They either draw down cash reserves, they sell off assets, or they borrow money.
That's what a company I worked for. They had a special dividend, and they borrowed money for that dividend at a really great rate, even though they had cash. They borrowed money, and so that's what they did.
Okay, so this is kind of an example of what we don't want to see, and this, to me, really highlights the difference between screening. Did it meet these criteria? Yes, check, 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 check. Met all those criteria. But when we actually research this, we go, not so much. So that's the difference between screening and research. So you'll have to hit the back button several times. So I want to get back to that list.
All right, we can go because we saved it. And I
Okay.
checked to make sure that
Yep. And
it's
while you're
still
doing that,
there.
I'll answer a couple of questions. Let's see. Beatrice in California, can you show us how to screen for the good penny stocks that will surge or go up more than 60%? Be very, very careful because a lot of low price stocks are low priced for a reason. And yes, they can be very attractive when they surge, but that's the area of the so-called quote pump and dump schemes, which are in essence a fraudulent way where scam artists literally promote a penny stock they already own through some of the internet sites. It runs up in price as individual investors buy in, and then as the individual investors buy in, the scammers are selling off, boom, down it comes. So be very, very careful with lower price stocks. Can you do the same analysis process for ETFs, Mitch in Michigan? The answer is yes, but you have to do it based on the weighting scheme for an individual ETF. As an example, the NASDAQ 100, the heavily weighted companies in that, well, one of them, Amazon, doesn't even pay a dividend, but Microsoft, Apple, you have to look at those companies, and you can do the same process, but it's a little bit harder. Emerald in California, in this particular workshop, most of what we're doing is the walkthrough on schwab.com, so there's not really a presentation for that. Mitch in Michigan, again, overall dividend yield or average earnings for an ETF. An ETF is going to be based on an underlying index, whether it's a broad market index or so on. So it will be the dividend yield for that underlying index. NDX is going to have the dividend yield of the NASDAQ 100, the underlying index. Let's see. Jim in Missouri, isn't dividend payout part of ROE? I got to tell you, that's way back in the study materials for chartered financial analysts. It might be, but I'm not really sure. David in New Jersey, is there a way to screen for stocks that some people are shorting? Short interest? I don't think that's one of the screening criteria. If you would, Nina, just click on the basic criteria for a moment. That's where it might be.
Yeah, I mean, you can.
Yeah, there it is, short interest right there. Don't click on it at the very bottom, but highlight that. So I guess you can. One of the things I love about this role is I learn something new every day. And let's see.
And I have a question for you, Mark. All right, so
Okay.
you have this stock position in your portfolio, and you're collecting these dividends, and how do you know when to consider selling the stock that has been paying you dividends? Because maybe you were more of a buy and hold and you wanted to do this more long term. Well, when do you
Okay.
start to, abort these plans and dump the stock?
There's an article that I've co-written with Adam Lynch and one of his colleagues from the Schwab Center for Financial Research. It's working its way through the approval process now, and it's a dividend sell strategy for dividend-oriented stocks. Excuse me. In that, one of the first things we talk about is when the trend in price breaks. Tell you what, let's do this. Go type in GE in the symbol. Everybody will get kind of a preview of coming attractions. I did get permission from our compliance department to name names. I've used General Electric as a case study. And here's an example where a company has, slashed their dividend. If you open all on the dividend history.
All right, open all over here. There we go.
And then
Down.
scroll down. And you'll see that they used to have a 24-cent per share dividend in September of 2017. In November of 2017, they cut that in half, And if you look at the top of the page, in October of 2018, they cut that all the way down to a penny. So
October, there we go. Mm-hmm.
yeah, so now go back to the summary page for GE, and we'll look at that 5-year price chart. So one of the first things that happens is once this price starts to drop, and if you look there, you know, once it dropped below, let's say 28, you know, when it started to turn red, and that's just coincidence, it started to turn red there. You don't want to sell a dividend-oriented stock just because price changes, but you want to treat that as like the smoke alarm in your house going off. Smoke alarm goes off, Nina, you don't grab the kids and the dog, pound 911 on your phone and go sprinting out of the house, but you're sure looking around on full alert. So a price drop should trigger the fundamental review that we just did, and you would have seen that General Electric's earnings and sales were dropping. Their dividend payout ratio actually had been over 100% for well over a year. And as it dropped below 28, notice that it didn't really plunge until November of 2018. By then it had already dropped from 28 to 18.
Mm-hmm.
Actually below that, about 13. So when it actually cuts the dividend, that's kind of, in my mind, too late. So that's a process. So let's go back to the screen, and we've got 2.5 minutes left. I want to look at one other one, so we'll walk through this much quicker. But I want to take a look and see what we can find in terms of something that might work. So let's go to our Happy Friday dividends again, and hide the screeners. There you go. And just while we're sorted on symbol, just go down to the ends. And I'm sorry, M. We want to look at MED, M-E-D,
Sure.
because that will show up on our list.
Now let me go.
Oh, MED didn't show up on this one. Okay, never mind.
Well,
Let's find.
well, it was there. It was, maybe something's in the screen. We could
Yeah,
type
type in
because it was
MED.
there. It
That's
was there not
MetaFast.
long ago. Maybe
Yeah.
something
Yep.
just changed by a little bit here. Let's look at that.
So again, look at the 5-year.
Mm-hmm.
We're getting our 2-minute warning here.
Mm-hmm.
So there's an example of something that ran way up, came way back down, fell again, and from a technical perspective might be getting into more of a buy range. But now look at the earnings, and we'll walk through this very quickly. Since we've already explained this, it should happen a lot quicker. So here are quarterly earnings. That looks a lot better. 18% year over year earnings growth, and they've already reported Q1. Scroll down to where we can see sales. Same thing, great sales growth. Again, ladies and gentlemen, this is not a recommendation. You need to figure out whether this meets your criteria, but these are some of the things we might want to look for. So go to the dividends tab. I just wanted to compare and contrast dividends up at the top. There you go, that'll work. And look at the dividend growth they've had. So now open all and let's see how long it's been since they raised their dividend. So they raised that in the December quarter of 2018. Their next dividend announcement should be in June. So we haven't gotten there yet. So that looks good. Dividend payout ratio just below 60, a little high, but just below 60. And that, again, that might be something worth keeping an eye on. So nonetheless, this is how we can actually research a company very quickly because we're looking at it with a very jaundiced eye. We see one
That's
thing we
right.
don't like,
Right.
one strike, and you're out.
That's why it didn't show up because we had 50 or less.
Ah, okay. Yesterday, I think we did 60, yeah.
Yeah.
All right. Sorry we couldn't get to everybody's questions, but thanks for the great questions. And Nina, I'll let you wrap up. Happy Friday.
All right. Once again, thank you for being our pilot today. That was great. And don't forget, we still have some more coming up. Up next, we have closing remarks with Joe Mazzola and Rob Fleming. Everyone have a great weekend and stay safe. We'll all talk to you on Monday. Take care. Bye-bye.